Well, we moved past the US CPI and the PPI reports, and the market anxiety has ramped up a little. But bond yields certainly need monitoring, and a push higher could increase market volatility. Now, as we look ahead into next week, we see landmines galore. It's a massive week. We've got the Fed meeting, we've got the Swiss National Bank, the RBA, the Bank of Japan, Banxico, Norges Bank, you name it. It's landmine city going off, as well as the Nvidia conference as well. So AI traders are going to be watching that one very, very closely indeed. It's time to get in front of the screens. This is the trade-off. Well, hi there. My name's Chris Weston, Head of Research here at Pepperstone, and I'm going to be joined by Mr. Blake Morrow from Forex Analytics. We will be going through the key thematics, going through the market, the setups, the trades that we like and have on our radar, and we assess what is a massive week ahead. Mr. Blake Morrow, you are fresh. Mr. Blake Morrow, you are fresh from your holidays. You're looking all right, actually, to be honest. I know that you kindly joined us from your vacations. You've driven back specifically for today's trade-off. You're looking well, mate. You're looking healthy. Was it a nice break?
It was a great break, and I want to extend my my thanks to the crew here at the trade-off for allowing me to film this like one day later, and I also want to thank you, the viewers, for sticking around and understanding that every once in a while we do need to take a day off here and there. So
it's not a sign of weakness. It's not a sign of weakness. It's good for the mind. It's good for the mind. But let's see if you've actually remembered I've been paying attention to the markets. I'm not sure if you've been trading the markets, Blake, but we'll find out, and let's get some of your views, and let's go into Topical Thunder. Well, Blake, you may have been sitting on the beach drinking margaritas, but we've had to navigate the US CPI and PPI reports. We've seen a bit of a backup in yields. We've got the 10-year now trading at 4.29%. We've got our eyes on those recent highs of 4.34. Yeah, can we break through those levels? Do we see term premiums rising? And yeah, it could cause long end rates to move up. Real rates have moved up a little bit. Yeah, interest rate expectations. Cuts have been priced out to an extent. I think we've got about 76 basis points of cuts now being priced by December. Obviously, that's 325 basis point cuts. Still a bit more than what some were saying we could get from a change in the dot plot next week. But certainly we've seen a bit of a rise in long end yields, and that has caused a little bit of anxiety in markets. But yeah, we've seen a slightly hot CPI print. You've just seen the PPI numbers coming through. The inflation number, obviously the advanced reading coming at 0.6%. The core reading month for month was at 0.4% month for month. And we take the components from the CPI print, we take the components from the PPI print, and we project them to get a sort of a run rate for the more important, in the eyes of the Fed, core PCE inflation number, which comes out on the 29th of March. That's obviously what they set policy to. The run rate that we're sort of estimating at the moment is the core PCE on a month-for-month basis is probably likely to be anywhere between sort of 0.25 of 1% up to 30 basis points, which puts you on a sort of annualized rate of about 2.8%. But I think when we say right tail risks, the left tail risks are slowing growth, and the market would be concerned about recession risks. We're not really seeing that too much at the moment. On the right-hand side is concerns around inflation ramping up again. So that's the right tail risk. We wait to the next CPI print next month, but we've seen a backup in bond yields. And how are you looking at the inflation picture, and how concerned should we be for financial markets here?
Well, first of all, let me clarify. I don't drink umbrella drinks. They're too much sugar. So a Dos Equis or a Corona on the beach is just my speed. So just to be clear. And I was actually watching the markets from afar, via mobile device. And it's nice that we get to do that, in this world at this time. But what I did notice is I noticed there wasn't a huge reaction, or actually not the reaction you would expect following the CPI. Stocks continued to rally, dollars sold off, but the producer prices today really kickstarted a little bit of a dollar squeeze. And I think the risk is that the market might be thinking that the Fed will maybe make an adjustment via the plots where we don't have as much of rate cut expectations going into the end of the year. However, I don't know if that's going to. I think the dollar could put it this way. I think the dollar could rally and it could stand to rally going into the FOMC next week. But in the fact of the matter is I think from there we might get some dollar selling. But I do want to say I think the risk at this point is for some dollar buying right now, and that's the way I view it, and that's the way I think price action led us to believe today.
I think you're right, mate. To be honest, we're touching a dollar in a second, but I do feel I feel like you've got to watch the bond market here. Whatever part of the curve you want to look at, but I feel there's probably some further upside in yields as we go into that Fed meeting. And I think the market will probably want to pare back any kind of length into that and run shorts, which pushes up yield. I will say that CTA's trend following funds, systematic trend followings now are pretty heavily short at the long end of the curve, and that will sort of limit some of the selling we're going to be seeing. But yeah, I think there's a real scope. We're at 4.29 on the 10-year now. I think there's pretty scope that we go and we break those recent highs of 434 through selling, and I think that would play into your US dollar trade there. So yeah, I think keep an eye on the bond market, both nominal and real rates, and I think that Fed meeting late next week is going to be the one that people will be looking to massage those positions and further highs in yields, and I think the dollar will go along for that.
Yeah, and that's the thing is I think you're exactly right. We need to watch yields, and so it's really going to take us into the next topic, which is the dollar. And I did want to have this discussion about the dollar because I think we are in a range-bound environment. Now, one of the central banks that's not in play next week is the European Central Bank. So therefore, that means we could really focus more on the euro to trade as a vehicle, and we can bypass all the other central banks, which we'll talk about here in a few topics. But I wanted to know from your point of view, do you see upside or downside risk from here? I kind of just laid out my plan on and again, this is how I'm going to be executing it is through the euro. I think the euro has a 107 to 110, battleground that's going to be fought. And I think that we can be actually playing the fringes sometime between now and the end of next week with the dollar as a whole, but the euro dollar is specifically from 107 to 110. Therefore, if right now we're near 109, just a little bit below 109, I think there's some upside risk for the dollar near term as the market's repricing, as you see yields move up. Whether we break 107 in the euro to the downside, that means further strength in the dollar. Probably has more to do with yields and exactly what you were talking about. But how are you looking at the dollar right now, and how are you going to look to position yourself going into this really, really crazy next week, Chris?
Well, I think you bring up a really good point. I mean, when we talk about all the central banks, which we'll cover in a second, by removing the event risk, because you're going to get those idiosyncratic movements from the Swiss National Bank, RBA, those factors. By honing on a central bank, then you really just work on the dollar side of it, which I think is a really smart way of looking at this, to be honest. So, yeah, I feel there's probably some upside in the US dollar. I feel there's probably some downside in euro dollar, although it's boring, isn't it? I mean, it's low. The volatility in euro dollar is shot to pieces, and maybe that's partly down to what we're seeing in dollar CNH as well. Dollar CNY is just dollar CNY is just not moving above 720. So yeah, I'd like to see a bit of movement in that cross, and I think maybe then G10 volatility can move up a little bit. But yeah, look, I think the real simple thing, and we're again sort of stealing from the future here, is this idea that we just need 2 of the 19 voters on the Fed board to move their median dot plot projections. And then effectively the median dot for this year is that we get 2 rate cuts as opposed to 3. It's only going to take 2 members to move their central case up a little bit. And I think whilst that's really a simplistic way of looking at it, I think that's just the way it's going to be. And if the market's got this vibe that we're going to see two cuts being priced in, semantics just play into that, and I think that would just support the US dollar. So as this becomes a more consensus view, I think this will support the US dollar, and then you just take out, you're isolating that by a central bank that's not in play next week. I feel there's probably downside in euro dollar in that. But yeah, if you're looking at vols, 1 week, 1 month, euro dollar vols, they are shot to pieces at the moment. So yeah, what does that mean for me as a trader? What does it mean for you, Blake, as a trader? Yeah, unless you're trading scalping. I mean, if you're taking sort of longer term time frames, trading off 4-hour charts or so, you can trade with a wider stop if a tighter stop, and increase the position size because the movement is not there at the moment. But yeah, I do feel there's upside risks in the dollar as the market sort of moves this idea that we're going to see 2 cuts being priced in as opposed to 3.
Chris, one other thing I want to have on everybody's mind before we move along is, and we're going to talk about this obviously in a lot of the setups that you're going to see here. Stocks are still poised right at all-time highs, or not too far off of all-time highs. What happens to the dollar if we do see some de-risking of the markets, continued de-risking of the markets? Does the dollar catch a bid? And that's another factor that hasn't really been a factor. Hasn't been a factor at all, really.
Well, it's the chicken. It's the old chicken and egg. Some people say, the US dollar strengthening is bad for the equity market. Some people say that, the equity market rallies and then the dollar sells off. So I think it works in different times. One thing I do know, though, is if you were to look at the Hang Seng, for example, and some of the Asian equity markets, then that is driven by the dollar. So, I think part of the rebound that we've been seeing in the Hang Seng and the H shares, for example, has been because of dollar weakness. And, they really need that US dollar weakness. So, it's a question of dollar. But typically, if you look at the dollar smile theory, rallies in equities, will be bad for the US dollar. It'll be a headwind for the US dollar. So it's an interesting point there. So if we do see a material drawdown, it's been hard to come, but if we were, then I think the US dollar gets a kicker from that. So we'll see.
Right. All right.
Right. BOJ. We can talk. I'm just picking out the BOJ, and I've selected this one. Obviously, the Fed's going to be the sort of the big sort of cross asset talking point next week, but. We're saying this it's Friday for me, Thursday night for you. And we're just about to hear later on today, as a lot of people are sort of leaving to go and get those frothies on at the end of the day, the Japanese Renko union wage negotiations. Now, the BOJ have said that, they want to see something sufficiently or significantly above 3.8% to get them excited. The unions themselves are pushing for 5.8% from the large companies. We're hearing from a few auto companies already that they're going to be close to that number. These are the highest wages that would happen in Japan since the 90s. 6% pay rises. A lot of people would like to see that, especially in Japanese inflation times. It's very positive real wages. But this would be the backbone for them then to come and change policy. So, we're talking about the Bank of Japan moving away from negative interest rates to effectively zero interest rates. They're talking about this loose cap of 1% being completely moved and moving into a more sort of QE world where they're quantifying how much bonds they're going to be buying potentially. But they're moving away from unconventional monetary policy to a more conventional policy settings, which is something that we haven't seen in Japan for a long time. How positive? Do you sit in the March versus April camp in terms of raising rates? Does it matter? And ultimately, how are you playing the yen on the back of this?
Well, first of all, I'm going to only be playing the yen of the long side, and I'm already there. Most of you know, since we've been putting up a lot of charts over the last couple of weeks here at the trade-off, talking about buying yen, and I've been shorting Canadian yen and Swiss yen particularly. So I'm playing the yen the long side. And that's the way I want to play it, because I do think that the BOJ has this opportunity where they have to move. Yes, you're right. They're waiting for the Rengo union negotiations to be finalized actually over the course of the next several hours from where we stand right now. And they have this door that's open to actually normalize rates to a certain extent. They've warned us a lot that it's going to be a very slow process, and they're trying to downplay what the risks are. But I think the risks are a little bit more heightened. And of course, they're not going to tell us that. They're not going to tell the market that. They're going to try to downplay everything. But I think the yen really stands to unwind. There is a lot of yen shorts in the market. There's a lot of people playing carry trades. And, everybody is Miss Watanabe nowadays. And so with that being said, all that needs to get unwound. And so you got to start looking at where the downside levels in the dollar yen, the 6J, if you're following just the contract itself, kind of see where the break points are, and where the break points are, try not to fade them, especially if you see some yen strength come through, because it could come through very, very fast and very furious. And that's the way I'm going to be playing it, Chris.
Slowly, then all of a sudden. I want to sell rallies in dollar in dollar yen and other pairs, to be honest. I think that's play. I don't want to be in it. I do think that, yeah, like positioning is obviously very important when you're trading currencies around, and certainly looking at the skew of risk around announcement. And yeah, I don't really pay any attention to the commitment of traders report myself, but I do say that yen shorts by leveraged funds are multi-year lows, and various factors, and that makes sense, right? Because of the carry that you just talked about. But I think there's a major difference between whether they raise rates by 10 basis points in March or April, and going on a hiking cycle. And I think, for me, that the Bank of Japan, if they raise rates by 10 basis points here, they'll make it pretty clear this is not the start of a hiking cycle. And that will then mitigate some of the strength that you're likely to see in the Japanese yen. For me, this is really about, if you want to go and buy the yen and get a really strong sort of 5% move over time, the market needs to believe that we're going to see more hikes this year. We've got 25 or so basis points of hikes being priced in by the end of the year. But I think the market needs to see that we're going to see 50 basis points by December for them to really start buying. So we get a token 10 basis points, we get out negative rates. That's psychological that they're actually moving away from this unconventional policy. But really, if we are going to see the yen catch up to where its fundamental value, we need to believe we're going to need to see more hikes being priced into the curve. That would get the market really exciting. I'm not sure we're going to get it anytime soon, though, unfortunately. We'll see.
Well, I would say that I would agree with you, but here's the thing, Chris. I don't know if you recall, like 3 months ago, the market was pricing in the chances of 6 rate cuts this year from the Fed. So, the markets can start to price things, and they can happen all of a sudden, all at once.
They can. You're right. Look, I'll take that and take that. And rates traders can get a little bit of emotional from time to time, can't they?
Sure. All right. Well, hey, let's, speaking of which, let's move to the next topic, but let's talk about the other central banks, because it's not just the BOJ next week. I mean, the BOJ, I would think, is the marquee event. And I know a lot of people everybody believes it because is it March or April, right? It's exactly what you just, asked me just a moment ago. But there are other central banks meeting. We have the RBA, we have the FOMC, the SMB, the Bank of England, Norges Central Bank, Banxico. You mentioned them as we were coming on. And there could be a lot of movements here. And I want to see where your focal point is going to be, because obviously you have the Fed. We talked a little bit about it. It's all about the plots. And I think you make a really great point about all it takes is a couple other Fed governors to move their dots over, and everybody goes, oh crap, now there's only two hikes maybe for the remainder of 2024. But then you have the Swiss National Bank that might actually cut rates. They are in play. We just saw inflation out of Norway. Banxico is probably in play as well. They might be cutting rates. Now, Bank of England is going to be a little bit of a wild card to me, because they still have inflation that's pretty high, and I don't know what to make of their political situation. I think we need to defer to our colleagues Ryan and Mr. Michael Brown to talk a little bit more about UK politics. And, but when you talk about other central banks, where's your focus going to be? Because there is so much more in play than just the BOJ.
Yeah, I think the Swiss National Bank is going to be really, really interesting. We're sort of there and thereabouts in terms of market pricing. It could go either way. That just tells me that it's going to be pretty lively in the Swiss franc. You can make up a case for 25 basis point cut. You can make a case for them to be on hold. I suspect in my gut now that they probably will be on hold, which obviously offers some decent upside in the Swiss franc. I sort of changed my view, from where we were. But I mean, I'm not going to trade it because it could go either way. It's like one of those situations where, if you want to trade over news, you've got to see a proper skew in terms of the probability. But I'm not seeing that right now. It is a coin toss, and that makes you be able to price risk around it very, very difficult. And that's why I'll be staying way away from it, to be honest. So I'd be closing out, waiting to see what happens, and then react afterwards, because otherwise it really is just you're playing it just for a hope. I mean, it's fun and do it in small size, but it's not really what I'd say is a trading strategy myself, unless you see a genuine skew. But I think it could go either way. So I'm watching that one very closely. I think, again, if they don't go at this meeting, they'll probably go at the next one. Bank of England, it's a holding one. RBA again, they're not going to do anything. The statement's going to be fairly similar. So again, that should be a fairly low vol event. The Fed and the Bank of England and the Fed and the Bank of Japan, and to an extent the banks are probably the ones that we that you want to watch very closely there. So some interesting ones. But yeah, I think you add in everything we've been seeing, and it's kind of this melting pot of central banks who get to market everything they're seeing and let us know the future or how they're seeing things as well. So the Fed's the big one from a cross-asset perspective, but I think the Swiss National Bank and the Banxico meeting, where you got the idiosyncratic risk coming through as well as maybe the BOJ. So exciting times, if you want to call it exciting. I'm not sure if you really should be calling it exciting, but it could get pretty lively in the markets. We'll see.
Absolutely. Traders, we call it exciting. And you know what? It's what moves the markets. It's divergences and convergences of central bank expectations that's going to move the markets all over the place. So let's hope for a lot of cross currents next week.
Indeed. Anyway, let's go to that setup and have a look at some of the charts front of mind. Before I do, Blake, I noticed just how white your teeth are. I was just wondering, did you actually go on holiday or did you just clean your teeth the whole time?
No,
I'm getting blinded.
But I do brush multiple times a day. So thank you very much for noticing.
It's a good habit to be in. Anyway, let's go to the HK50, the Hang Seng, if you will, and let's have a look at the daily chart too, because we are in a longer term downtrend that's been in play. This is one that I put as a play of the day on the short side. It was working well, and then we had the national team come and step in. I've taken a small loss, a very small loss on that trade, but it's working in this kind of wedge at the moment within a longer term downtrend that's been placed. So we've seen a technical bull markets playing through. It's rallied 20% off those lows. It hit the sort of the lows, the measured move, and we're now working within a wedge, and that needs to reconcile itself out as well. So the problem I've been saying here with we're trading the Hang Seng here is that when we get those short moves, it's been very difficult because every time you get a 1.5-2% move to the downside, you see ETF buying, or you hear of ETF buying from the national team, and the market rallies. So they just don't want the market to go down in that capacity. That said, I think if we get a break, Blake, of this longer term downtrend, I think you will see a lot of people chasing this market higher. I think you're going to potentially see a trend as well. I mean, we're seeing huge inflows through the southbound connect into Hong Kong stocks. You've seen better liquidity as well, but we are in this channel. So it says to me that we need to wait. But I think if we get a break with the longer term channel, I think that's going to be on a lot of people's radars. And I think that could set a bull market off and a longer term. And I think people will chase that situation. So I'm waiting. For me, it's a great setup. And we've got earnings that come out in Hong Kong and the H shares over the next couple of weeks, including names like Tencent, that could be a big driver as well. Haven't given you much time. How are you seeing this one?
Well, first of all, I can't help but notice that descending channel that you pointed out. And look, I'm going to grasp at straws here, and it's not something that I trade. I don't trade the Hang Seng very much as a U.S. based trader. But what is going to be the driver of a breakout, Chris? I mean, got earnings. What do you see?
Earnings could one, but it's liquidity. It's always liquidity, and maybe. I think you've also got to address the elephant in the room, which of course is confidence around the economics. And we've seen some signs of, we haven't seen the bazooka that everyone wanted, of course, but you've seen some better signs of data, and property's still a concern. But that would be for me the real backbone to get international capital into these markets. We're not seeing that necessarily at the moment, but it's got to come from the data flow. But we've also got, as I say, we've got earnings coming through over the next couple of weeks, and that could be a driver as well.
And I just thought about it is next week. I almost said next year. Next week, the 1 and 5 year loan rates might be adjusted from the PBOC. So maybe that might be a driver next week, right?
Well, the prime rate is essentially the rate that banks can get, or households can get funding from or capital from the commercial banks. So it's slightly different from the medium lending facility, but this is just one of the sort of policy levers we have. But this is the sort of benchmark. If you're going to go and get a mortgage or a house loan from a commercial bank in Hong Kong, essentially in China, this is essentially the sort of benchmark so I don't think anyone's expecting a cut at this one, but if we get a surprise cut, then obviously that should boost equity prices.
They got levers. They got levers. All right. Well, I'm gonna take us to the next and my first setup, which is going to be the semiconductor index. And I just wanted to say, with the semis, it's kind of like a vacation. I think you need to take your socks off and relax here. And so, if I could get the advance in the, there we go. Take your socks off and
took his
relax.
time, didn't he? The producer. Jesus.
Yeah, that's all right. Sleeping at the wheel, it's okay. It happens. But Chris, this is a head and shoulder pattern setup in the semiconductor index. And you guys got to watch it really carefully, because the SOX actually points to much lower levels. Now, we got a breakdown today, and I'm going to just point out that the head and shoulder pattern, ironically, will point all the way down to the 38% retracement. So that's a slump below the 50 DMA, all the way down to basically the 4,400 level in the semiconductor index. And that's a 38% retracement of the October of last year's lows to the highs that were posted in March, or earlier this month, just like a week ago. There's a lot of semiconductors that you should be watching, whether it's AMD, there's Marvel Technology, I think, is a good one. Microchip, Nvidia obviously is in the semiconductor index. So keep your eye on the semis, because they have been the market that's been leading the charge higher, and now they're starting to show some signs of weakness. So how are you seeing the semiconductor index here, Chris? And does it look like we're seeing a reversal?
Well, the first thing I look at is that 50-day moving average has been a brilliant trend filter. For people who are looking at mean reversion strategies within the rising trend, so that I think that's one. But people it's pretty clear that has set the trend off. So I think a firm break of that 50-day moving average would psychologically be very, very important for the market, and obviously that would play into your head and shoulders target, which may develop over time. But yeah, I think that's the first thing I think of is will we see support, as we've seen on a number of occasions through from December, and see that as a potential change in the medium term trend that we're seeing. So that's one thing there as well. But yeah, I think shorting this market, shorting semis, has been a very painful trade, a frustrating trade, should we say. Is now the time? Do you know what I'm thinking though, Blake? The better trade for me is I know you're highlighting a setup rather than an explicit trade, which is why we do this segment. But for the trade that I really like at the moment, if you want to be short a stock in the US, I think Tesla at the moment just looks disgusting on the higher time frames. The selling price of used Teslas is down 50% from the highs. It just goes down. Month on month, they're cutting that. The chart just looks really, really quite poor at the moment. I think this is a market where the buyers are drying up. I think the sellers, the short sellers, are having an easy time. So, I like the setup that you've brought here. It's a lot of people resonate with them, but I think for a trade right now, I think being short Tesla makes a lot of sense. I haven't got the chart in front of me, but maybe we can put that in the post. But I think being short Tesla makes sense right now.
Well, before we move along into your next setup, Chris, I do want to point out this is actually a 4-hour chart. So it is a 50 period moving average, not a 50 DMA, because usually I put up a daily chart. But I do want to also point out that as you pointed out in your comments, the 50 period moving average on this 4-hour chart has been very, very, it's really kept this index in check. So it's definitely worth noting. It just 100%. Is a 50 period moving average.
Oh, good man. Yeah. Okay. Cool. Well, I think playing into your semis is let's go into the chart on the video as well. Now, I want to just pretty touch on the I've got, what have I got here? I've got the daily chart. So there's a screw you up. I was just saying if I got a 4-hour chart, but we can see this kind of consolidation pattern at the moment. Price after a ridiculous move that we saw, is now just consolidating, and the market really doesn't know what to do. We can't push it down, we can't push it up. There's a bit of a battle. There's a sort of lack in conviction. I mean, obviously, we talk about these massive gaps that need to be filled down 742, 688. It's a long way to get down to those levels. I certainly would be skeptical that we get down and try and fill that gap at some stage. But we need to break through those recent swing lows that we've got the orange line. I can't remember exactly the number there, but that could be quite important. Now, I will say this quickly, Blake. Next week, on the 18th to 21st, we've got the GPT conference. This is where Nvidia will get together and showcase the adoption of generative AI, the future of generative AI, how they're seeing graphic cards, all these factors, where they're going to see their potential sales. This is great insights into the AI scene. There's analysts are talking about it. They're going to have different data scientists talking about how they're seeing this. This is a must-watch for AI. Whether you're talking about Marvell, whether you're talking about AMD, as you talked about, the guys who are taking these chips in, the whole scene's going to be watching this. It has typically been a very positive affair for Nvidia. I know there's a lot of investors who want to wait for the GPT conference to come out and then buy the stock. They wanted to do that after earnings. So there is a massive catalyst, and as we know, as goes Nvidia, as goes so much of the marketplace at the moment. So we talk technicals aside, we have a huge event risk next week. Jensen Huang will be speaking on the 18th, obviously the CEO there, and generally speaking, he hits the market where they want to. The market hears what they want to hear from him. He knows how to hit the sweet spot. So big one there. Technically, we're in this consolidation, but huge event risk for global markets from this Nvidia conference next week. So I'm watching that very, very closely. How are you reading this one quickly, Mr. Blake Morrow?
I like the consolidation, and I want to also point out that that low that you have, it's the orange line, the first one that comes in around 842. Really, really key support, and I think that watching that is obviously going to be really important because we break that.
Well, that plays into your head and shoulders on the socks, right?
It does, and then the gap fill becomes more of a, maybe this can happen. And I do want to point out gaps. I've seen gaps fill like a year later, 2 years later. There's no like designated time like, a gap, it's going to get filled. It's going to fill tomorrow. No, the gaps can stay open for a long, long, long time. Just FYI. But I also want to say, I think it's really nice that it's a consolidation. It's a setup, and I think you got pretty clear parameters on whether you're going to resume the trend or you're going to actually start to break down and get a little pullback. And last thing I want to mention is, are we past now watching Apple product launches? Because I've been done with it for a few years now. So are we past that now?
Well, unless they, they haven't. Yeah, just releasing these products at the moment. There hasn't been anything that the market's gone, whoa. Yeah, we got to buy the stock. This is going to change the earnings profile of the company. And people have been using Apple. I mean, as a kind of funding trade for long Nvidia positions. Last week I looked at the idea of being long Apple and short Nvidia, and that trade's doing okay. But I think it's not really. There's more explosive trades to put on in this market right now. So sort of just taking that one to the sideline at the moment. But yeah, I think, if Nvidia does pull back significantly, I'll be looking at, long Apple, short Nvidia, not because of any kind of product range situation, but just because the market has been using short Apple as a kind of funding trade for that long Nvidia position as well.
That's a great setup and great points, Chris. All right, I'm going to take you to our last setup today, which is the Russell 2000. And this is, you notice that my caption here is swing and a miss. And that is a baseball analogy. And it's just a whiffed ball, swing and missed and tried to rally, got a false breakout. Now, if you look at that dotted line, and I can't smush this chart together because I wanted you guys to see the colors of the actual candle, which is, black or red or however, it's just bearish. But you extend that line all the way over to the lows. Like there's a bunch of lows that come in right around that 2100 level back in 2021. So those levels extend way back. You have to just keep looking left in your charts. However, this 4-hour chart, if this is a daily chart, but if you went to a 4-hour chart, you would see that this also has a head and shoulder pattern. But what's more prominent right now is we've broken an ascending trend line. So getting a false breakout above 2100 in the Russell 2000, that was flat or swing and a miss number one. Breaking below that rising trend line, that's swing and a miss number two. And now you have a market that so many analysts thought that the Russell 2000 would be the standout market this year. But as we've been talking about, Chris, multiple times over the course of 2024, right here on the trade-off, this market has been underperforming the S&P, the NASDAQ, even the Dow. And so when sellers start to emerge, they're going to pound the Russell 2000 first and foremost. So I think this market is at risk of breaking the 50 DMA on this chart and trading down towards the 200 DMA at minimum in the weeks and months ahead. So, Chris, how are you looking at the Russell 2000?
We're going to get short this market. I quite fancy it, to be honest. I think that's probably where the problem is. Is going. I've been at risk at times of saying that I think the Russell is going to outperform the S&P, and it's not really been a great trade. It's been a frustrating trade, but I feel like you've got to keep an eye on the banks and the KRE. I mean, we watch that one very closely. If bond yields do move up, in the long end, I think that's going to really impact a lot of these small cap stocks as well. So, keep an eye on the 10-year. If we break that 434 level, then I think what we're going to see is you're going to see an underperformance from the small caps and de-risking, and that's probably going to see a bigger move coming down. So, do I see? Obviously, we've got three choices here. Do we go long? Do we think it's going to trade a short, a sideways sort of choppy range, or do we think it's going to go down? That's where we're looking, and we're sort of assigning probabilities to each one based on positioning, based on other factors, and of course, price action and flow is more important than anything else. I think there's probably more downside risks. I'd skew it to the downside. Therefore, I'd be looking to go short in this market myself. If you put the gun against my head and say, Chris, pick one of the three, I'm going short.
All right, I won't put a gun to your head.
Thanks, mate. That's fine. But just show me your teeth. I mean, that works just as well. Anyway, let's go to play of the day. Bringing up a cheeky one here, Mr. Blake Morrow. I'm going to have a look at the crude markets. We've seen the International Energy Agency coming out and talking about a deficit for this year that was unexpected, but obviously the moves from OPEC have moved them into that world. We have seen inventories starting to draw down from the Department of Energy weekly surveys as well. And that supported the market. Now, we've got this bullish channel. We're breaking out of this recent consolidation. I like that move. Obviously, these things do roll over and give you fake signals quite often. And that's something that we're considering. But I think there's upside here. Now, what I potentially would look to do as well for people out there who are looking at this is I think there's a scalping opportunity on the short side as we hit into the top end of the channel. I think sort of around 82.70 or so. I feel like we'll probably get to those levels. I think there's going to be an opportunity to scalp shorts on that one, just take some quick moves to the downside. But I think if you're taking a sort of swing approach and you're taking longer term timeframes, this is looking pretty constructive. Nat gas is starting to look longer term. It doesn't, but I think we're starting to see some further upside in nat gas. I like being long there. But I think this market from a daily perspective, 4-hour chart, is starting to work quite nicely. The fundamentals are warming up to that situation. Demand might from a economic growth perspective may be called into question. Certainly, if we were to see bond yields moving up and a little bit of a rollover in equity markets. But I like this. I mean, I think we're going to see it. So just to summarise, I think for the scalpers out there, I think there's an opportunity if we get into that 82.70 top end of the channel. I think we can look at short positions into that. But for me, as a more sort of longer term time frame, I think this is looking pretty constructive. I think this starts the bull trend.
All right. Well, I was going to say it was a big close today above $81, Chris. I think it looks bullish. So, and remember, we talked about this a few weeks back. This could be the Achilles heel of central banks moving forward.
I don't think it's at the moment, though. I mean, interesting. I just want to touch on this is that if you look at short-term inflation expectations, 1-2 break-even rates, they have been moving up quite aggressively, and maybe Crude can explain that as part of the explainer as well. But if you look at sort of what the Fed looks at, which is kind of five-year break-even rates, which is sort of longer-term inflation, they're still very well anchored. So despite what we're seeing in moves in crude, longer-term inflation expectations, which I think are really important, haven't started moving up yet. So it's pretty clear that the move in crude is not, from an energy perspective, is not impacting those type of inflation expectations just yet, which is kind of what I'd be looking at as a kind of risk-off proxy there.
Key term yet. So you're saying we got a chance, Chris.
We got a chance.
Exactly. All right. That's Dumb and Dumber for those of you that didn't catch that pun. All right, let's take a look at the pound New Zealand. I hate this pattern. This is called an inverted head and shoulder pattern. But you know why I hate it, Chris? Is because technicians have become lazy in the last 10 to 15 years. They think all markets go up. So everything's an inverted head and shoulder pattern. But if you go and you grab the Technical Analysis Bible by McGee and It's behind me right over here in my office. Anyway, if you look at head and shoulder patterns, they're actually reversal patterns, not continuation patterns. And this would be classified as a continuation pattern. But that doesn't mean that we can't break out. And I love the pound New Zealand because we got the BOE next week and we have the RBNZ not in play. We do have, I think, GDP next week for New Zealand. But I'm looking for a break above the 210 level. 210 is the 618 retracement. You get much above that, we're probably going to squeeze back up to 212 and maybe even higher. Maybe it does complete and it actually breaks into new highs as a continuation pattern. But head and shoulder patterns and inverted head and shoulder patterns are actually reversal patterns and not continuation patterns. But I know everybody else is looking at it, so by default, I guess.
I was reading a white paper. I was reading a white paper on this the other day, which I have to share. But yeah, I get pulled up for saying, oh yeah, you got to have a reversal. These have got to be right at the lows. But the research I was reading is that actually the high probability is that they work really, really well as continuation patterns. So yeah,
that's because we've been in a bullish market for like 13, 14 years straight. So again, people get lazy. It is because we've been in this Fed and central bank generated rally. But
whatever, it's going up by whatever.
Yeah, I don't. But that's interesting. I'd love to read that white paper, and I'm going to shoot holes in it all day long. No, but it's good. I'm glad somebody's going to be a statistician and not me and try to do that stuff because I just don't have the time. So.
Well, thank you, Mr. Blake Morrow, for coming back from your holidays, and for the audience for sticking around and watching the show. Please give us a like button if you did like it. Leave a comment down below and pass the show on to your friends to let them know what wonderful content this is. Anyway, thank you all, guys and girls, for watching the show. We'll see you back next week for more of The Trade-Off.